Hello and welcome to the ISDA AGM studio. I'm joined by Benny Crapanzano, who is an ISDA board member and Global Head of Financial Resources and Strategy, and by Jacques Vigner, who's also an ISDA board member and the Chief Strategic Oversight Officer for BNP Paribas. Thank you for joining me.
Thanks, Mark.
The US endgame proposals were published in March, and they made important changes to the viability for internal models for market risk. How important are these changes?
So first, I'd note the changes are significant to the model approach and generally all very positive. The policy intent is clear to have banks incented to use the model approach, especially for large trading banks with diversified businesses. The proposal mostly achieves that for technical changes, as well as the recognition of diversification where it wasn't previously. I'd say we're in good shape there. But it does raise the question of how do we get to a point where we're approved and can actually take advantage of these changes. The timeline is tight to get model approval. So I think at this point, it's very important to have clarity of process and timeline to achieve the goal of getting model approval and take advantage of these positive changes in the proposal.
Thank you. Jacques, why are internal models so important, and what changes would you like to see in Europe so that more banks can adopt internal models?
Well, the internal models are of paramount importance for aligning risk management, day-to-day trading decisions, and capital measurements. So this is key to have this internal model palatable for the banks. On the contrary, the standardized approach is very rough. It creates hard behaviors, it brings a low visibility on the trading book, and it makes the supervisors partly blind. So really, for me, the standardized approach is a bit the Stone Age of capital management and risk management. And on the other hand, we should come back to the future. The future is the IMA. We should make the internal models great again. So what do we expect from the European Commission? First of all, I would say I'm very grateful to the European Commission, which has released last week a draft delegated act whereby it will change a number of technical rules in FRTB and introduce a capital multiplier to neutralize the impact of FRTB for a maximum duration of 3 years up to the end of 2029. So this is, of course, very, very good. Goes in the right direction and allows us to play on a level playing field with the US Basel III endgame. And I think this is also very important for the European economy because we need, for the European economy to thrive, we need the European financial industry to be able to support growth and the many challenges we have to cope with. So, and beyond the 3 years to come, beyond this delegated act, of course, we need the European Parliament, the Council of the European Union, with the help of the European Commission, to make these changes permanent and also add additional amendments that will be helpful beyond FRTB to credit, to SACCR, to everything within Basel III, as there are many things to change, as we have witnessed with the US Basel III endgame. There is one thing I would like to point out, which is the output floor. So as you know, in the US, the output floor has been dropped, and I think there are very good reasons for this. In Europe, there are also good reasons which are slightly different, because with the internal models on credit, we expect the banks to be able to be close to the output floor with the credit risk, and that would leave very little leeway to improve the market risk. So if we want to entice banks to embrace internal models, we should really make a carve out for output floor. At the moment, there are only 3 banks in Europe applying for internal models. This is really a shame, and we need to react.
Okay. Thank you both very much for your insights.
Thanks, Mark.
Thank you.